Hello and welcome to For Trade Limited. In this video I will explain what fundamental analysis is and why it's so important when making your trading decisions. As many of you will know, most traders use both fundamental analysis and technical analysis when making a decision on what to trade. We also believe this is the best way to increase your chances of successful trading, but we will be covering technical analysis in another video. As a general definition, fundamental analysis allows us to analyze important political, economic and social forces and assess their impact on the forex and stock markets. Fundamental analysis involves the interpretation of statistical reports and economic indicators released by government agencies or the private sector, so-called macroeconomic analysis. They can include interest rates, inflation, purchasing managers' indices, production capacity, consumer confidence, rates of unemployment, or retail sales figures, among many others. On the other hand, microanalysis involves focus on narrower segments, for instance, companies and different industries. Fundamental analysis is important since the indicators that I just mentioned can have a direct and to some degree predictable effect on the value of a nation's currency, in both the forex market and upon stocks and commodities. Hypothetically, this means that a trader who is well informed and understands how to interpret the indicators stands a better chance of doing well in the markets. The key economic and political factors are also known as high-impact events. Interest rate decisions. This is the most important regular economic factor that can be depended upon to move the market. It's extremely important in the valuation of a nation's currency and a vast array of financial products. If a country's central bank is planning to set a high interest rate, generally speaking, that nation's currency tends to attract assets from countries with a lower interest rate, which influences the currency to grow in value at or near the announcement of a rate increase. Market expectations are very important. Analysts often predict the results of the most important indicators. To take an example, the current interest rate set by the European Central Bank is 0%. But if most analysts were expecting it to remain at 0%, and then the ECB decided to increase the interest rate to 1%, it would very likely cause a sharp rise in the value of the euro. Markets take predictions from respected analysts seriously, so when something unexpected happens, it can have a dramatic effect on prices. Central banks set interest rates in a monthly or bi-monthly basis. Inflation is the increase in the price of goods and services. Inflation figures are usually announced on a monthly basis. Inflation is a concern to currency traders as it affects the price of everything bought and sold within an economy. And this has a direct impact on the supply and demand for a country's currency. Inflation is also important from another perspective. It's also a key economic metric driving central banks' decisions to formulate their interest rate policy. Most major economies currently target a rate of 2%. Typically, the further away released inflation figures are from that figure, the more volatility is to be expected after such an announcement. Unemployment is another significant economic indicator that can move the market. One of the most keenly awaited market-moving events, for example, is the United States non-farm payrolls, where the NFP statistics, unemployment rate and average earnings are announced on the same day by the US Bureau of Labor Statistics. A lower unemployment rate gives economic support to a hike in interest rates. Gross domestic product is the monetary value of goods and services usually and is a primary indicator used to judge the health of a country's economy. It is typically released on a yearly or quarterly basis. GDP has a particular impact on stocks, since a good or bad economy suggests higher or lower earnings for companies. But GDP announcements affect currency values too. As far as geopolitical factors are concerned, elections often move the markets, particularly if one candidate is favored by the markets due to their economic policies, for example. There are even traditional market trends unrelated to candidates or political parties. For example, in the US, historically, stocks will grow in value in the days before an election. However, what we would normally expect pre- and post-election is market volatility. Referendums of vital national interest, such as the UK's Brexit vote to leave the European Union, also cause huge volatility, and in the case of the British pound, have caused its value to sink. Terrorist attacks or wars can have a dramatic effect on the markets. Oil prices, for example, are particularly affected by terrorist attacks or armed conflict in the Middle East. I will provide some concrete examples of how geopolitical factors have affected the markets in a moment. But before then, let's consider the economic calendar. An economic calendar is also a crucial part of the fundamental analyst's toolbox, since it lists the release date and time of important events and statistics. For example, an economic calendar will show you when the Federal Reserve is due to meet and announce if there is a change in the interest rate. It will show you last month's figure and the figure that analysts expect to be announced. Please watch our video on the economic calendar where I will describe it in more detail and how to use it. The election of Donald Trump on November the 9th, 2016, which was a surprise for most, caused incredible volatility upon global markets, with the price of the dollar affected, as you can see here. The dollar index first went down 2.28% in value upon the news of the election result, and then reversed, increasing 2.91%. On the day of the election, the euro-dollar went up 2.82% upon news of President Trump's victory. But over the following days, the euro-dollar reversed and was down 3.85% by the 14th of November. Most stocks were also down upon the announcement of his victory, as investors initially flocked to safe haven assets such as gold before the markets recovered in a similar way to the dollar. Brexit is another great example of a turbulent event that caused massive movements on the markets. Once the result of the UK's decision to leave the European Union was known on 23rd of June, the pound reacted by crashing some 11.9% against the dollar. Brexit has dominated British politics and economics ever since, and when an exit poll was published on the 8th of June, only hours before the official British general election result was known, the pound dropped again by 1.5%, its largest fall in 4 months. This was due to political uncertainty leading from a potentially hung parliament, which would mean that the UK government would not have a firm mandate or unity to conduct Brexit negotiations in the way it wanted. The recent threat of war between North Korea and the US also caused considerable volatility on the markets. In August, as the dollar slipped following President Trump's statement that the US would rain fire and fury upon North Korea if the country continued to threaten to attack the US, the price of gold jumped to 1275 and continued climbing in the following days, to its highest level in almost 2 months. We can see here that the same thing happened with the Japanese yen, another traditional safe haven instrument. The yen climbed as a result of the speech. As traders know, in times of instability, investors usually move towards these safe haven instruments. Terrorism can have a dramatic impact upon the markets, although this is usually for a short period following an attack. When London was targeted on June 3, 2017, the reaction of the markets was to again invest in safe instruments. As we can see here, the gold price increased 2.86% in the days following the attack. However, it's important to remember that terrorist attacks' effect on the markets are short-lived. Although companies involved in tourism or air travel, for example, may see their stock prices negatively affected for a longer period. But as terrorist attacks become more frequent in recent times, market participants tend to react less strongly. I hope that this video has convinced you of the importance of fundamental analysis when making trading decisions. As I've demonstrated, the impact of geopolitical events and economic factors both have a clear impact on the markets. Please join us again at 4Trade soon.